So you've probably heard about meme coins, right? These things can go from a joke on the internet to a billion-dollar asset, like overnight. But what's really going on behind those crazy price charts? To get to the bottom of it, we're going to take a look at one token in particular that caught our attention. It's called $UGOR.
I mean, look at that! The world's most powerful resource, now decentralized. Wow, that's a heck of a pitch, right? It sounds big, it sounds important, like something you don't want to miss out on. And that's exactly the point. It gets you excited. But is it just a great story? All right, let's really get into it. Okay, so before we start digging into the data and all the technical stuff, we have to understand the story they're telling. Because every project has a story, and this is the one UGOR wants you to hear.
And what a vision it is. One world, one reserve. Black gold for all. The whole idea is that this token, it represents oil, the most crucial resource on the planet. And instead of being controlled by the big guys, it's owned by the community, by you. I mean, you can see why that's so appealing, right? It hits all the right notes about fairness and taking back control.
And this is where they try to back up that big vision with some technical stuff. They throw around terms like zero tax, burn liquidity, renounce contract. Now, if you're in the space, you know what these are meant to signal. They're all about trust. Burn liquidity and renounce contract basically mean, hey, we developers can't touch the money or change the rules. It's safe. It's all designed to make you feel like your investment is secure and the game is fair.
Okay, so the story is compelling. No doubt about it. But here's the thing about crypto. A great story is just the beginning. You always have to look under the hood. So now we pivot. We're going to check the on-chain data, the hard facts, and see if reality lines up with all that hype. And that brings us to, well, the million-dollar question, or maybe the billion-barrel question. Analysts at CoinCodex and others started asking, for a token named the United Global Oil Reserve, where's the oil? Is there anything real backing this thing up? So check this out. On one side, you've got what a real asset-backed product looks like. Legal documents, public audits, a way to actually redeem your token for the asset. Normal stuff. Then you look at the UGOR column, and it's just empty. No verified evidence, no public audit, nothing. The lesson here is pretty stark. Just because something talks like a commodity doesn't mean it's actually backed by one.
All right, and if you weren't convinced yet, this should do it. According to analysis from FEMEX, the total on-chain liquidity, the actual money available for trading this global oil reserve, is about $269,000. Let that sink in. A project with global oil in its name has less cash in its trading pool than the price of a decent suburban house. It's tiny, so tiny that just one person selling a medium-sized bag could send the price into a nosedive.
And it gets worse. On top of the tiny liquidity pool, look at who owns the tokens. 40%, nearly half of the entire supply, is sitting in just 10 wallets. 10! That's a massive red flag. It means a tiny group of people, probably insiders, have the power to completely crash the market whenever they feel like it. Everyone else is just along for the ride, hoping they don't.
So all these red flags we're seeing with UGOR, it might feel like we're just picking on one project, but we're not. This is actually part of a pattern, a playbook, really. And thanks to some pretty amazing academic research, we can actually see what that playbook looks like. So let's zoom out from UGOR and look at how this game is often played. Yeah, just look at that number, 82.8%. A recent academic paper found that over 80% of meme coins, with those crazy high returns, showed evidence of artificial growth. Think about what that means. It means most of the time that rocket ship price action you see isn't real people getting excited, it's manipulation. Okay, so tool number one in this manipulation playbook is something called wash trading. It's pretty simple, actually. It's basically like hiring a bunch of people to stand in line outside a new nightclub. You create the illusion of demand. In crypto, an entity just buys and sells the same token to itself over and over again. It makes the trading volume look huge, which tricks real investors into thinking, wow, this thing is popular. I should get in on this.
Now, wash trading is kind of old school. The next tool is way more sophisticated. Researchers call it liquidity pool-based price inflation, or LPI. And this is where it gets really clever. It's a way to use this system against itself, especially when there's very little liquidity. Sound familiar? Like the situation we saw with UGOR?
So how does this LPI magic trick work? It's shockingly simple. Step 1, you create a liquidity pool with almost nothing in it, like pocket change. Step 2, You use one of your other wallets to make a tiny little purchase from that pool. But here's the kicker. Because the pool is so small, that tiny buy sends the price absolutely soaring. The paper found you could use like 30 or 40 bucks to trigger a 300% price pump. It's an insanely cheap way to make your token look like it's the next big thing.
So, okay, fake volume, fake price pumps, why do all this? What's the end game? Well, it's exactly what you think it is. It's all about setting the stage for the final act, cashing out. You build the hype, you lure in real people with real money, and then you pull the plug.
And that final act usually takes one of two forms. You've got your classic pump and dump, where the insiders who pumped up the price then dump all their tokens on the newcomers. Or you've got the even more brutal rug pull. That's when the developers just take all the money from the liquidity pool and vanish. Poof, gone.
And make no mistake, this causes real harm. We're not talking about play money here. That same research paper tracked the money and found over $9 million in losses for regular investors. And where did that money go? Well, almost $8 million of it went straight into the pockets of the creators and insiders. It is, plain and simple, a massive transfer of wealth from hopeful buyers to savvy manipulators. So let's just put it all together. Here's the playbook, from start to finish. Step 1, you launch with an amazing, compelling story. Decentralized oil, for instance. Step 2, you use tricks like wash trading and LPI to fake momentum and make the price chart look incredible. Step 3, that fake success gets you noticed. You get on coin trackers, you get talked about on social media, and that's when the real investors pile in. And then step 4, the end game. The creators cash out, and everyone who bought into the hype is left holding the bag.
All right, we have gone deep on this. We started with the story of one token, UGOR, and we zoomed out to see a system-wide playbook for manipulation. So, what does this all mean for you? What's the one thing you should walk away with?
It's this, right here. A compelling story is not the same as a sound asset. I mean, the UGOR story was fantastic. Who wouldn't want to be part of democratizing global oil? But the data, the actual verifiable on-chain data, told a completely different story. A story of high risk, low liquidity, and concentrated ownership. The narrative is meant to sell, but the data tells the truth.
And so that's the real challenge for anyone in this space, isn't it? In a market that runs on hype, how do you know what's real? How do you tell the difference between a genuine revolution and a carefully laid trap? The line between the two can be razor thin. But hopefully, after seeing this playbook laid out, you've got a better toolkit to figure it out for yourself.